Let's get to our final trade of the day now with Mike Patton, head trader at Funder Trading, talking about a stock that sometimes moves on wildfires.
So my trade today is going to be Pacific Gas and Electric Company. The symbol is PCG. So a little background. This is a power company located in California. And back in 2019, they had a bit of a debacle with some lawsuits regarding wildfires. And of course, the recent wildfires have actually impacted their stock and moved it down dramatically. However, it's not clear. It actually seems pretty clear at this point that they're not going to be liable for much in that regard, because it looks like most of their grid is not located in the areas that are most affected. However, the market seems to still feel that there's going to be some after effects from that and perhaps some problems. But it has moved the stock down sharply. I think about 26% at this point. Stock's currently trading near $16 a share. But this does look like a good opportunity for a buy. I don't think that the situation is going to deteriorate any worse. I think the market's already priced in the potential risk of lawsuits, et cetera. Lawsuits based upon like a power line going down and short circuiting and starting a fire, things like that. So currently the stock has some pretty good metrics either way. Right now its valuation is really in the basement. I mean, it's at one of the lowest PE ratios that it's actually at the lowest PE ratio it's seen in 5 years. Currently it's seeing an increase in institutional ownership. It looks like institutional traders are picking up on this, major investors. So they've increased their stake by 3.4%. Seeing more fund managers buying it. It's now being added to top 10 lists. So this looks like a stock that's in demand right now. So I do see some significant upside potential. So looking at the raw numbers right now, the lowest expected target for this stock over the next 6 months to a year is $20 a share. So it's already $4 higher, 25% higher than where it is now. The middle target's around $23. So I do see a lot of upside. But in the event that this situation does not develop in the way we expect, let's say that some more problems come up. I would say if this stock gets below $14, about $2 lower than where we are now, that would be a good time to get out. So basically, we have a minimum $4 to $6 of upside potential, risk of about $2. More likely than not, we've already seen the lower end of the range we're going to see for now, but we'll find out.
What about the stock market? Bullish or bearish?
This is a mixed bag because we saw the financial sell off sharply. And I have to admit, I haven't really gotten a good read on why that happened. I've seen a variety of different explanations. But as of right now, maybe it's concerns about inflation, et cetera. So I don't think we're going to have a runaway bull market this year. That doesn't seem to be likely. However, I don't actually expect that we would have a massive sell off either. So I think we're just going to see more sideways volatility going forwards for a while. And as the picture begins to get clearer and it's clear, which industries are going to do better and which ones are going to do worse, I think things will start to really pick up. So I would say in the second half of the year, I would expect that you'll start to see more things picking up. You'll see some stocks really starting to show signs of greater strength. But for now, I would expect more or less sideways. We'll probably creep slightly higher here and there, but we'll have these turn downs and then maybe come back up. That's my expectation, but obviously that could change dramatically since we don't know, what's coming up in the next month or so. So we'll see.
We have to leave it there for today, Mike. Thank you.